President Biden announcing a trip to Saudi Arabia as high gasoline and oil prices become a huge priority. Price of oil is marginally lower right now after hitting $123 earlier today. We're up 7% already this month. And our next guest says this price could go as high as $175 a barrel. Paul Ciana is Chief Global Fixed Income, Currencies and Commodities Technical Strategist at Bank of America. All right, Paul, give us the bad news. What do you see?
Oh, hey, Kelly. Look, I see bullish price charts in oil from the daily, weekly, and monthly perspectives. You know, the big picture story, which is part of my favorite part of technicals, is getting to look at the long-term trends and looking for secular changes. And that's what we did back in May of 2021. We called for upside in oil prices to 105, 134, and maybe even $175 a barrel. And we're marching that direction faster than expected, but we're getting there.
If all the Russian barrels came onto the market magically somehow, would that change the situation? I mean, I know you're a technical strategist. We're talking about the charts and the patterns here, Paul, but I mean, could that be an exogenous event are there any other exogenous events? They're in D.C. They're talking now about windfall taxes and things like that. And I don't know. What brings us down? I don't know.
Yeah. Let's talk about price, because price is what brings us down. It's the market participants that bring us down. The last piece of news out, Kelly, that really mattered to maybe bring down prices was, I believe, July 1st, when Saudi Arabia announced that they could increase their supply to the market, right? They could increase the amount of barrels of oil going into the market. And what did oil prices do that day? They went up. Almost 5% off the low. They had a knee-jerk sell-off and rallied to close near the high of the day. So show me a news headline that is bearish oil where prices move bearishly lower. We haven't seen that yet. Oil goes up on good news. Oil goes up on bad news. And It just formed a bullish continuation pattern about 7 trading days ago when it broke out above about 115 alongside that Saudi news, actually, and is continuing higher. I think we see 140 this summer. That's reasonable. Could we get all the way to 175 already? Can't rule it out.
No, and I have people all the time say we could spike to 200. They're not ruling that out, and I just think that's a really interesting point about how it's trading on those kinds of days. All right, it's not just oil, and interestingly, you see the dollar going up further as well. So normally strong dollar is a headwind for commodities. So it's incredible that oil is still this strong. It speaks to how tight real demand is. But what are the dollar charts telling you? Because we seem to already be at extremes here.
We are. The dollar index, or the DXY, as people quote it, broke out to new 20-year highs last month. And look, as a technician, you break out of a range consolidation to new highs like that, it's bullish. And the dollar, honestly, it's not even that overbought. There's room for momentum to persist. And I think when we look back at the long-term charts of the DXY, there are multiple analogs to where the dollar was trading in a narrowing range, like it was the last about 7 years, breaks out to the upside and just continues to trend. So think, DXY at 105 right now, that's new 20-year highs. What if it put on 5 more points? It'd be at 110. That would be euro probably at parity, maybe flirting with a break below. It's really, though, bullish dollar Korea, because the dollar getting stronger here, it's a headwind for risk assets. Oil prices getting stronger here, it's a headwind for risk assets.
Yeah, everything you're describing with the dollar has investors, corporate America, everyone just groaning and saying, please, not that. Okay, so finally, let's talk about the 10-year. Kind of makes sense. Yields and the dollar would rise together here, but we pierced through 345 just this afternoon. What's the next stop?
We did. So we do something called Fibonacci extensions to estimate upside when there's a breakout to multi-year highs like 10-year Treasury yields. Some of our analysis shows that the secular bull market in bonds is over as the head and shoulders bottom pattern in 10-year yields formed. Coincidentally, just like the head and shoulders top in 10-year yield began the secular bull market back in the 80s. So really a big win for the technicians that the head and shoulders are controlling the bond market direction. But aside from that, pattern analysis, the next extension level, treating a bear market like a bear, is about 4%. Somewhere between 398 and 405 is where a number of Fibonacci ratios and targets actually line up. It's possible.
If we were to go lower, what would that take, or what would that look like?
Lower in yields, you get a breakout like this through 3.25. The fourth quarter 2018 yield highs was 3.25%. We're already at about 3.5. Why don't we come back down and retest 3.25? And if we do, you sell it and you look for 4%.
Yeah, I was going to say that's not exactly the downside. I think people were looking for 20 basis points. Paul, I really appreciate it today. Thanks for your time.
Thank you.
Paul Ciana with Bank of America.